Good day, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial. I'm the coordinator. Today, we've decided to take a little bit of a turn on our session. What we're looking at is we're looking at all the questions that came in through the year since we're nearing the end of the year, the ones that are fundamental to financial planning. And we've got a great panel in the room that are going to be looking at those questions and giving you some financial planning answers to those questions. We have a diverse and talented panel to do that for you. But first, some housekeeping. The first thing I want to look at is sound. Make sure your sound volume is as high as possible. And with that, as well with sound, if you look at your screen, there's a panel on the right-hand side of your screen. If you find a small high five, if you can just click that for me, it will indicate that you can hear me so that we can carry on with the session. The more high fives I get, the better. So small, there you go. Thank you, Trevor Grace. Thank you, Stefan. All right, thank you, Rebecca. Thank you, Nompumelelo, Neville. All right, the high fives are coming up. Thank you, Karen. Thank you, Alicia. Awesome. So I assume sound is good. Second thing, questions. If you have any questions during the session, you are more than welcome to type them up on the very same panel. There's a title saying question to type those up. What we'll do is at the end of the session, we'll address those questions for you. Okay, so today's panel consists of our resident DJ, Mr. Errol Meyer, who is our advisory and propositions legal specialist. He's a certified financial planner, admitted advocate of the High Court SA, and he holds qualifications in finance, law, taxation, and teaching. With him, we will be looking at the topic with our 4 dynamic, good-looking financial planners. And if you don't believe me with that, when I say good-looking, I want to show you the next screen, which is their pictures. So there's proof. So I'll start giving you the intro from the left. We've got Irshad Shandulao. Now, Irshad holds a BCom in accounting. And no, we did not make a mistake. You're not seeing double. He is part of a set of twins. And the gentleman next to him is his brother, who is Shakil Shandulao, who also holds a BCom in accounting. The third picture is of our beautiful Tandega Zuma, who's the rose amongst the thorns. She's currently in the process of completing her BCom degree in industrial psychology. Then the fourth and last picture, we've got Karabo Dlodlo, who possesses a degree in financial management. So that being said, that's our panel of 5 today. So what I'll do is I'll step out of the hot seat and allow Mr. Errol Meyer to sit down and take us through the presentation with the planners.
There we go. Thank you, Katiwe. And good day, attendees. Welcome to our second last webinar for the year. Last time we had a panel discussion and we received some very interesting questions by our audience. However, throughout the 2019 year, we have received many questions that we thought are very relevant to the discipline of financial planning. We have therefore collated the questions, selected what we regard as necessary, tweaked it a little bit. Now, I will pose these questions to our panelists and ask them for their responses. So let's get on with it. And I will start with Irshad, followed by Shakil, then Tandeko and Karebo, and then I will open it up. So let us have a look at the first question that came up. If I can get it on the screen there. There we go. Thank you, Katiwe. So here's the first question. This person asked, and a discussion more often when it comes to financial planning. I have some debt, a home loan and credit cards. I have some money and need, I should pay off my debt or start investing? Very good question.
Thank you, Errol. Well, there certainly is an argument to be made that no debt is good debt, but borrowing money and taking on debt is the only way many people can afford to purchase big-ticket items like homes and cars. While such loans usually are justifiable and bring value to the person taking on the debt, there is another end of the spectrum that involves taking on debt through careless spending on a credit card. While it's easy to differentiate between these two extremes, determining whether or not a debt is good debt or bad debt more often involves a deeper analysis of specific circumstances. When it comes to good debt, there's an old saying, it takes money to make money. If the debt you take on helps you to generate income and increase your net worth, that can be considered positive. There are a few notable things worth going into debt for, such as investing in real estate, starting a small business, or using the debt to pay for furthering your studies like going to university. While good debt has the potential to increase a person's net worth, it's generally considered to be bad debt if you are borrowing money to purchase a depreciating asset. In other words, if it won't go up in value or generate income, you shouldn't go into debt to buy it. Some particular notable items related to bad debt include cars, clothes, and consumables and credit cards. Now, I want to go into an example here, as you can see on the screen. In the top corner, it's basically an example for someone that has a bond and at the same time he started investing. If you go into the top left-hand side of the corner, this person has a 1.4 million rand bond. He has an interest rate that is paying 10.5% per annum. And this bond is a 20-year term. His repayment amount is 13,977. On the right side of the column, you can see he's at the same time investing 2,500 at an interest rate of 13%. And after 20 years, he has about 2.8 million in his bank account. But don't forget, this 2.8 million he has in his account, he now has to also consider the bond payment that he has been paying every year, which obviously takes out the money that he's earned all these years. So now, in the example, what if he, instead of investing, he takes that money and injects it into the bond? What will happen? What difference will it make? As you can see at the bottom left, instead of paying 13,977, he now is paying 16,477. As you can see, he will pay off his bond by 84 months earlier, which is equivalent to 7 years. So essentially, he will pay off his bond instead of 20 years, he will pay it off in 13 years. So what difference will that make? So now, after paying off in 7 years earlier, he will then take that full amount that he was paying in his bond and now invest that money into the investment of which he was earning 13%. But keep in mind, this time he doesn't have any bond payment. He just has the full amount he will get. So in this case, he will get around 2.2 million in 7 years. But remember, he now has no more bond payments. So which is in the difference now we can see you'll have 600,000 difference. But now if he invested this 7 years, he got 2.2 million. Imagine now if he had 20 years investing, how much more he'll get. So as you can see, the interest on loan diminishes the gains on the investment. I would always recommend paying off debt first so that you can free up more capital, which you can use to increase your investment contributions. I would like to give some tips to avoid debt, which is I would recommend to create more than one income stream. In other words, don't put all your eggs in one basket. Spend less than you make. Understand your needs versus wants. Needs points out as something you must have for survival. On the other hand, wants refers to something which is good to have, but not essential for survival.
Okay, well, that sounds interesting. So what I hear you say, from an investment perspective, it makes a lot of sense to get a return on your monies to pay off your debt.
Yes.
But now I'm paying off my debt, and I have about 500,000 in my bond, and my wife says, you know what, my husband, you've never cheated me. Don't you think we should take this money, spoil ourselves? And I think that is often a danger. So I tend to think you must be very well disciplined, and you need some kind of financial coach if you're going to follow that strategy. Even though it may be the best from an investment point of view, the discipline must come with that.
And discipline comes with practice. The more you practice, the easier it gets, and the more comfortable you get in doing your discipline in investing and in financial planning.
And then don't you think one should have a very clear vision on your goal of your child with that monies? You're going to have a different discussion when mommy wants it perhaps for going to Mauritius.
Yes, this is when we bring back the goals-based financial planning. Once we have a goal, then it's very difficult to go sideways with your goal. When you have the goal in place and you have one direction, then it's very easy to achieve that goal.
Absolutely, I think that makes sense. Well, yeah, let's the next question. And I guess this was from last time's seminar. As a 32 years old millennial, I had a late start of starting retirement annuities, investments, life cover, etc. My worry is that my late start, as well as my desire to buy a house and a car, etc. What would you make of that?
Firstly, I would say it's never too late to start, but the sooner you start, the easier it is to reach our financial objectives. Since you started late, I would recommend you utilize your tax incentives on your RA and use it to put it back into your RA to further enhance your contribution, which will increase the compounding effect. Hence, this will allow your RA to make up for lost time. Financial freedom can be broken down into 4 levels. The use of a financial planner can help you address which level you currently are and where we need to progress to the next one. So as you can see on your screen, there are 4 levels. It starts with security. So security is when you have passive income to pay for your basics, which is your rent, your food, your utilities, and transportation. Then you move on to the next stage, which is independence. At this stage, you have passive income to pay for all of your current expenditures. Then you move on to stage number 3, which is freedom. At this stage, you have passive income to pay for your expenditures and a little bit more of luxury items you can now afford. And on the last stage, which is stage number 4, which is abundance, this is now where you have enough passive income to pay for everything you want and everything you need. So this is the stage we all want to be at, but you don't just start at stage number 4. We look at ourselves, we always start at stage number 1. Okay, but some may be at different stages than others, but then using your financial planner, you identify which stage you are and then you progress to the next one.
Okay, so what I'm hearing is that it seems like financial planning, you must always follow a structured approach.
Yes.
You must have a plan.
You have to have a plan.
It's not having a plan.
Yes.
That's actually the problem. Now, whether it's a good plan or a bad plan, any plan is better than no plan.
100%.
Is that what I hear you
100%.
say? Okay, and then furthermore, you can actually categorize and you can measure yourself. Where am I?
Exactly.
Because everyone is achieving to get to number 4.
Yes.
So you can track yourself.
This is now where we talk about the goal space. If we're in security in stage number 1, if our goal is to be at abundance, then we now have our plan in place, then we can move towards the line.
Okay, right. So a more technical question, moving on to the retirement funds. The question that we received, can I retire from a pension fund and still contribute to a retirement annuity? And then the second part of the question is, what are the tax implications and other considerations that I should consider? So perhaps I must just make it a little bit clear here that when a person retires, you can retire from the fund these days and also retire from employment. It doesn't have to coincide. So our retirement fund landscape has changed quite considerably. Well, that is a mouthful. Who's going to answer that question?
Well, to answer your question, yes, they can claim a tax deduction after they have retired. There is no rule to how many RAs you can have. You can retire from one while still contributing to another one. Unlike before, where we see pensioners retire at a set age, in today's time, they're prolonging their retirement date so that they can maximize the tax benefits that they receive from contributing their RA. When they finally do retire, the rule of thumb is that a third will be received as a cash lump sum, which will be taxed according to the retirement tax table, and the remaining 2/3 will be received as a living annuity, which then can be taken as an annual drawdown of between 2.5% and 17.5%. It is important to know that this is fully taxable as income in your hands.
Yeah, so I can add to that. When it comes to retirement, it is one of the most important decisions that you can make. And I always say this is the stage of so many options. And this is where one needs guided advice. I would say that buying a house is a very important decision. But when it comes to retirement and the choices you make to take the 1/3, how big that should be, because you're going to pay a tax on that. with those monies? Should I invest it all into a life annuity, or should I invest it in a living annuity? It's a myriad of questions. And the interesting thing is, once you've made a call, it's a point of no return. Very seldom can one reverse. And that's the tax. How much cash flow and budgeting is so important. How much do I actually need? All relating back to financial planning. Then we got a question which to me was quite interesting. I used the question as is and maybe explain a bit. And what they asked us is, can you please define short, medium, and long term? And I thought it was a very good question, because we so quickly to refer in the industry, financial planners will say, well, this is short term, this is medium term. But how long is a piece of string? So when is it short, when is it medium? And I think the most important question is, so what? What is the relevance of short, medium, and long? Because that has a very close correlation to your investment and also the goals that you set on your journey through life. So what would your take be on that one?
Thank you, Errol. From an investment and financial planning view, for us to be able to differentiate between the three, one must first identify the goals of the investor, as well as the risk and term required to achieve such goals. When we talk about short term, we're usually looking at the 1 to 3 year time horizon. For example, a holiday trip. One of your primary goals with short-term savings is to not lose money by investing in low-risk investments, such as investing in the money market. When you're looking at the 2-year goal, the amount of money you save is more important than the interest rate you earn. In this short time frame, there's simply not enough time for compound interest to really work. Medium term refers to investments with a 3 to 5 year time horizon. So your goal is further away than a short-term investment, but it's not in the distant future, like say your retirement. Medium-term investments make it possible for you to ride out some market volatility, which you can't in a short-term investment. An example of medium-term investing would be paying for your children's education. Long-term investments sit on the distant horizon. Is usually more than 5 years away, but can be up to 30 or 40 years in the future, like your retirement or buying a house, for example. Time is on your side, so it allows you to be able to ride out the volatility of the market.
Okay, so I note the term there, 7 years plus growth funds, and I assume that would be equities.
Yes.
And I think if you would ask people if equities is perhaps not an aggressive strategy as people put it out there in the market. But if I were to ask you if I would invest into equities for a term of 30 years, would that still be an aggressive strategy? And the answer is simply no, which pinpoints that term is absolutely crucial and that compounding effect. And the result is to beat inflation. And that, once again, is the goals-based financial planning philosophy. Right, so let's move on to some more tax here. And the word tax-free appeals to everyone. So we do have some solutions out there, like retirement tax-free investments, known more popular as. And the question we received, can you reinvest returns from a tax-free savings investment to another tax-free savings account?
First, we need to look at the fundamentals of a tax-free savings investment. The amount that an individual can contribute into this account is capped at 33,000 Rand per annum and 500,000 Rand over their lifetime. Investors may contribute via debit order every month to a maximum amount of 2,750 Rand per month. The investor can make regular ad hoc withdrawals at any time. However, he or she cannot recontribute if he or she has already used up the annual or lifetime contribution limit. Parents may make contributions to a tax-free savings account on behalf of a minor. However, withdrawal must be paid into a bank account in the minor's name. Any amount exceeding the 33,000 Rand per year limit will be taxed at the rate of 40%. This means that if you paid 1,000 Rand over the limit, you will be liable to pay 400 Rand in tax. Should investors have more than one savings account, it will remain their responsibility to ensure that they don't overcontribute to a tax-free savings account that they may have with other financial service providers. There is no withholding tax on dividends or interest, and no income tax or capital gains tax on any switches or withdrawals. So what, you may ask? Well, the investment will grow further due to the savings on the costs. Legislation previously did not permit transfers between different tax-free savings accounts, but as of 1st March 2018, investors are able to transfer seamlessly between tax-free savings accounts without the risk of being penalized.
Okay, well, that's interesting. So what I'm hearing is that a taxpayer, let's say daddy in my example, would be able to contribute 33,000.
That's correct.
Until he reached the 500,000 cap, and mommy can do it in her own name.
That's correct.
But we can also do it in a child's name. Now that
correct.
can fit in with the goal that in 10 years' time the child must go and study, and the monies you said will be paid into his bank account.
That's correct.
So, and there are no negative tax implications, and you optimize by using the contribution for each family member.
That's correct, yes.
But the problem is, if that child doesn't want to go and study, and he takes that money, then he's entitled to do so. So one has to look at holistically at the risk and not only at the tax advantages.
That's true, but considering when a child, let's say, turns 18 and they're starting their life, that would be a good problem to have compared to starting with zero. So that's my take on that.
I love that example. So you've got to educate the children. Absolutely. Let's move on to the next one. And this is again a question on retirement. And I thought this was a very good question, because people often hear tax and they do not know where it fits in. So the question here was, I need to understand the difference between a tax-free savings account and a retirement annuity.
Thank you, Errol. Well, when you look at it, retirement annuity, it's an investment vehicle that allows investors to be able to save towards retirement. Now, the nice thing about a retirement annuity is that the tax is deferred till retirement. The retirement is not subject to capital gains tax or dividends withholding tax. And a lot of people don't know is that individuals can actually contribute up to 27.5% of their gross taxable income, which is limited to 350 per annum. And this, in turn, would allow individuals to then get tax relief or an incentive from SARS, which they then can contribute towards either a tax-free savings account, or depending on the age, they can re-contribute into the retirement annuity.
Carrying on from Tandeka, taking into account the fundamentals of a tax-free savings and the retirement annuity that we discussed earlier, the important differences between the two products are the following. For example, a top-up of your RA contribution is tax deductible, while a tax-free savings account contribution is made with after-tax money. Secondly, your retirement annuity can only be accessed when you reach 55, while a tax-free savings account investment can be sold at any time if you need to cash it in. Thirdly, you have greater investment freedom with the tax-free savings account than you do with your retirement annuity. Investments from a retirement annuity need to comply with certain legal limits which fall under Regulation 28 of the Pension Funds Act. This limits the amount of equity and currently limits offshore exposure to 30% of the value of your retirement annuity portfolio. In conclusion, taking aside the objectives of an investor, it's not a matter of which of the two is better, but rather having both the retirement annuity and the tax-free savings to help complement each other to create a more tax-efficient solution.
Yeah, so it sounds like it's different horses for different courses. The contribution to a retirement annuity up to a maximum of 350,000. But what if you contribute more? Well, interesting enough, then those deductions that you don't claim this year can roll forward and even after retirement. But I think if we have to pinpoint here, when you look at a tax-free savings account, it's liquidity, it's available at any stage, and the full amount is available. When you look at the retirement annuity, which is likely to be a different purpose, as you said, after the age of 55, you only have access up to a maximum of 1/3. And I think those are the fundamentals, perhaps also, that one will take into account to decide where does it actually fit in. Good. So let us move on to more investments. And there was a question about asset classes, and asset classes is the equities, property, bonds, and cash. And this was what the question was all about. And I'm going to ask Thandeka just to delve in a little bit more detail. And the question was, what does asset class mean? And then comes a very important question. How long should one be invested in an asset class? And one tends to ask now, do I choose only a bond, or must it only be equity, or is there perhaps a combination? Is there value of a combination? What is the relevance of it? There's a myriad of questions running through my mind. So, Thandeka, tell me, how would you see that one?
Well, just to answer the first part of the question, an asset class is a group of investment options that have similar characteristics. Now, for how long do you want to be invested? So the 5 main asset classes that we usually find is cash, bonds, equity, property, and commodities. So for example, if as a 27-year-old I'm investing towards retirement, I cannot invest in cash because it would never be in line with inflation. I would then have to look at your real estate or your equities. But if I'm saving for a holiday in December that I would have started investing in January, then it makes sense to then invest in cash because it's money readily available.
So what I hear as well is, now, I think people tend to think that if I invest in cash, I'm actually very conservative and I'm not taking any risk, which is absolute nonsense. Because if it's for 10 years, as you pointed out, that you're not going to beat inflation and the value of your money is going to be less. So with other words, investing into cash for a long-term strategy is actually a very risky and interesting. Good. So we've dealt with investments, we've dealt with term. So let's move on to some other aspects of risk planning. So here was a question: why is life risk management important? And maybe start off, just explain to me, what is the question, or what does life risk really means?
Well, when we look at life risk management, it's basically looking at you as an individual and the risks that you can be subject to. So the simplest way that I usually explain to my clients when explaining life risk management and why it's important, I usually say that as an individual that earns an income, you are your most valuable, and in the event that you can't earn that income, you should have means in place to protect that income and know that as much as you are not able to earn an income, you make provisions. And by doing so, we look at your income protection, we look at your disability cover, we look at your critical illness. With the medical advancement that's happening now, you are more likely to live a very long time, even after having cancer or a heart attack. So in order to make sure that you can maintain your standard of living, you have to put cover in place. And more so, if you have dependents, then it's very important to secure them through our educator plan.
Yeah, something that I pick up is that we tend to think if I earn an income, therefore I must replace my income. But let me give you a scenario, and I think this is always, or very often also overlooked. Let's assume here I am earning an income, and let's assume I have 5 small children.
Yes.
So mommy is going to find it very difficult to work. So we would tend to think if something happens to me, there's going to be problems from a financial planner point of view. But let me ask this: what if something happens to mommy, even though she doesn't earn an income? So that means all of a sudden I can't go and work. I need to appoint someone. So one tends to think is to replace an income is actually to replace a specific need that's going to have a financial consequence. And I don't think everyone always thinks out of the box in that respect. But let's move on to the next one and delve a little bit deeper. Can I use life insurance as collateral when taking a loan? So what is this collateral and why would one do that?
Okay. Let me first say that you are allowed to use life insurance as collateral, but I think we should just delve into what using life insurance. Basically, if you are taking out a loan and saying that you are going to use life insurance as collateral, it means that you are ceding the policy and therefore giving up your rights or then appointing your lender as the beneficiary of your policy. Now, it's okay to do so, but I think it's always important for people to remember why they took out the policy to begin with. So it's important to speak to your financial advisor and perhaps look at rebudgeting, look at other alternatives like liabilities cover, bond cover, because you don't want your children to have a specific asset but remain destitute because there's no income. So they have this privilege of this car or this property, but they don't have income to live.
So one must be very careful. If, for instance, what I hear you say, if the purpose was you took out life cover because if something happens to me, there should be a certain amount for mommy and the kids. But then I go and buy an asset and I make a bond. I have a bond for, let's say, R1 million. And they say, don't you have life cover to seed? Yes. And I seed it across. So what about the original purpose? So one has to be very careful, identify those risks and see how you are going to cover them. Definitely. Good. So let us then talk about diversification. And I don't know who's going to deal with that. Karabo going to deal with it. And Karabo, the question that came up here, is it advisable for me, oh, this is a good question, to invest offshore, and does Standard Bank accommodate this? Now, let me just start off by saying, people I find and I read with emotional reasons and often forget about the logical reasons why someone is investing offshore. I don't know, Karabo, what do you want to say?
Thanks, Errol. Just starting with offshore investments, one needs to think about why are you going offshore? So, like you mentioned, emotional reasons. So, is it something where you're looking at moving offshore? So, do you need to maybe look at property or maybe start to convert some of your assets to whatever currency you're going to be living in? But then, if you look at it from an investment return perspective, any part of portfolio management should include some diversification. An offshore component should be included in that portfolio. So the first reason would be to diversify. And then the second thing, if you look at this next chart here, so you'll see of the global GDP, South Africa actually makes up less than 0.5% according to the World Bank. So just from a diversification return in global GDP, it makes sense to go offshore just to participate in all markets across the board. And then if you look at local blue chip companies as well, although you are investing in multinational companies, so they still derive most of their earnings outside of SA. So diversification should be part of any portfolio management strategy going forward.
And I think when we talk about offshore, there are actually two ways of doing it. One is directly taking the money offshore and put it somewhere else. And the other one is where you can invest it locally in a type of feeder fund and you get the exposure. So it's two different kinds of risk. One, and also when you do that, there are various different tax implications, whether one should invest directly offshore from a when one decides not emotionally just to go offshore, you've got to suss out all the different risks that we have. So here's a very good general question. and I think if not one of the most important ones. There are so many solutions out there. We media use investment, and some people get all hyped up because they heard the word cryptocurrency, they heard the stories, and they actually don't go into detail. So the question is, where do I start? Where is the beginning that I should consider?
So I always advise clients, you need to first look at what goal are you trying to achieve. So define your goals. A good measure would be, I mean, it goes back to what we're talking about. A good measure would be using the SMART acronym. So define your goal. Is it specific, measurable? Is it attainable? Is it relevant to you? So are you going to carry on when the times get tough? And what time length do you look at? Financial planning will be things that are already mentioned. So it always starts with downside protection. So life risk management, where we look at things like death planning, disability planning, and etc. Then creation. Look at the end and then bring it closer towards you. So look at your retirement planning and then come down to shorter or closer timeframes.
Yeah, I guess this is where the word risk profiling is so important. It depends on the person, because you may have daddy and mommy, they're both working, whether they've got 2 or 5 children, whether the one may receive an inheritance. So you've got to look at the total risk profile and say, according to that, I suggest what we do is then determine the goals, your why, that's important to you. And quite often, what people do is start with a simple thing, like a budget. On the retirement, you should start with a budget, because your budget is your lifestyle, which is your why, what is important, what is necessary, and what is not so necessary. And according to that, then one would go about and prepare a financial plan. So here, and I think we've dealt with this a little bit to some extent, but the question was, I'm about to retire, what advice can you give me? And let me say, retirement, the person who can advise on the retirement is the financial planner of the future, because that is an area that there are so many traps and pitfalls, and as I mentioned before, it's sometimes a point of no return. Yes, who's going to deal with that one? Karabo. Yes, let's hear.
So like you mentioned, Errol, retirement is actually the most important decision you can probably make in your life. Retirement, there's a few key things to consider. So if you look at the following charts, there's things from a consideration of income requirements, size of your capital lump sum, inflation, spouse, and dependents. But just to simplify it for you, when it comes to retirement, especially from a compulsory funding perspective, there's 2 different options you may have. So you can look at a life annuity, where this guarantees you an income for as long as you stay alive. The inflation risk and things like longevity, as you can see in that picture, is carried by the insurer or institution, whereby you don't need to worry about outliving your capital. On the other side is a living annuity. So this is where we have to look at how much capital do you first have, so the size of your capital sum. With a living annuity, you can leave it to dependents, but there's also a longevity risk where you can outlive your capital and you carry the risk in terms of investment return and how to best adjust the drawdown on that annuity itself.
Yeah, and it's so true that longevity is one of the greatest gifts that we have in currently, but it also is the only way to actually counteract that is with proper financial planning, budgeting, and the choices that I make in retirement. Okay, so we're getting to the end of our webinar, and let me ask this question and address it to all of you. We are preparing for year end, the holiday season, so that one can start the new year on a good financial footing.
Thank you, Errol. I would say start early and get a head start. The period right after the holidays is the perfect time to check over your budget and make plans for the new year. How did you do? Did you stay within the budget? Were there places you could have cut back perhaps? In the end, it's all about tracking your expenses. That's what I would say.
I would say at year end, most people get the bonuses, and it's obviously festive season. They enjoy their time, but it goes back to what I was saying before, where I talk about needs versus wants. I'm not. Don't get me wrong. I'm not saying you shouldn't go to a holiday or spend time with your families in a holiday. But do we really need a holiday while at the same time owing 1.4, 1.5 million in our homes as a mortgage? I would recommend maybe take a portion of it, pay off your mortgage, and then a small portion maybe do spend time with your families and enjoy the holidays.
Oh, I would just say budget, be responsible. A lot of us are getting bonuses in December, so buy school uniform with the bonus and stationery. And lastly, February is around the corner, so take advantage of the cash flow advantage with SARS.
That's perfect. So in terms of budgeting, I would definitely recommend staying within your budget, because remember, this whole year you should have some sort of holiday plans done with your financial planner. So stick to that budgeting. And then second thing would be, from a marketing perspective, I'd say don't be deceived by clever marketing. Remember, even though you're making a 50% saving, you're still spending money on purchasing a new item. So just be careful around that.
Okay, well, thank you to our panelists. And perhaps Katiwe, before we start looking if there are any questions for us, maybe let me just close off with this. I look out for our next webinar when our Chief Economist, Kevin Links, I think in about 2 weeks' time, we'll be doing a webinar. This is a must-attend webinar, and I'm sure that the reflections of Kevin after the medium-term budget speech will be very valuable and set the scene for financial planning next year. And as always, we will be running a 2020 post-budget speech webinar where we will be unpacking whatever surprises is coming our way. So be on the lookout for that. So Katiwe, if you can help us and see if there are any questions that we maybe have overlooked.
Will do. Thanks, Errol. And while I check for the questions, just to remind you, the webinar is recorded. So you can look out for the recording on our YouTube channel that will be posted in about 3 days or so. We've got a question from Stacey Solomons. She says, hi, when is the right time to start saving for your, that's the question that came through. The right time to save for it.
I would say start as soon as you can, because the longer you wait to save for your retirement, the more expensive and the more difficult it becomes. So obviously, the sooner you start, the better and more beneficial for you in the long term.
And also, like I said before, when you do your retirement, you take advantage of the tax incentives, which you can then put back into your retirement so that it can increase the compounding effect.
Karabo, what did you say?
The earlier the better. So just to add on to that, I'd say, remember, it's about time in the market more than anything else. So if you look at the effect of compounding over any time, the most compounding or the most return years are towards the end of that period. So the earlier the period is from a retirement planning perspective.
Yeah, I would say, let me throw you a curveball. It depends on the age of that person. So we just assume that retirement is going to be something in the future. I heard earlier today, we're talking about financial independence. So who says it's going to be at 63? I tell you what, in 20 years' time, I'm quite confident that the retirement age is either going to be abolished, maybe be taken on as unconstitutional because you're telling someone to stop working. So I think there's quite a lot. So I would say, if it's not for retirement, maybe for financial independence. It could be a second career, another job, turning a hobby into a passion. And I think this is the type of way that one should think about it. And currently, as you said, we get all those tax breaks.
Okay. So a mouthful. I hope that answers that question for you, Stacey. Everyone gave you a little bit there to take with. For now, that seems like that's all the questions. If you are looking to carry on the conversation with a financial advisor, financial planner, please do walk into any Standard Bank branch. There's a financial advisor waiting there to assist you. If you'd like to make it another way to get a financial advisor to contact you, you can SMS the word guide to 31791. That's 31791, and one will contact you. Or you could email SBFC Voice and Digital at standardbank.co. Digital at sorry, that's SBFC Voice and Digital at standardbank.co.za. Just write in the subject financial advisor, please, and then someone will contact you. I hope that was beneficial. Like I said, it was recorded. We'll be on our YouTube channel soon. I will be seeing you in about 2 weeks' time, as Errol said, with Kevin Links when he does the last webinar of the year. And until then, we wish you well, and we'll see you soon. Goodbye.